Imagine this. In just 9 months of 2023, the country has borrowed a whopping $1.4 trillion. That's like borrowing more than the entire economy of Mexico in less than a year. And in June alone, they added another $228 billion to the pile. It's got everyone biting their nails because it could lead to a big trouble for the economy. Now, everyone's turning their heads to look at Warren Buffett, the super smart billionaire investor. They're all wondering, what's Buffett going to say about this mess?
I was early in October of 2008, and I said stocks were cheap, and I wrote an op-ed in the New York Times. But I'll probably have some chance, once every 5 or 10 years to make a definitive statement. There is a big zone of reasonableness. Anybody thinks they can pinpoint it is crazy. It's not that precise. And fortunately, you don't need to. If you buy good businesses at reasonable prices and hold them, you're going to make a lot of money. And that's true of stocks as a group. It's true of individual companies.
He's seen as a wizard when it comes to money, so his words carry a lot of weight. In today's video, we're diving into Warren Buffett's warning about a looming economic storm in 2024. The legendary investor has raised the alarm bells, comparing the potential crisis to the 1929 Wall Street crash and the Great Recession of 2008. We'll explore the factors contributing to this forecast, the risks associated with real estate bubbles, and what steps you can take to prepare for the storm. So buckle up as we unravel Warren Buffett's insights and analyze the current economic landscape. So without any further ado, let's dive in. The housing bubble and its risks. To comprehend the impending economic crisis, we must unravel the intricacies of the housing bubble, a phenomenon wherein property prices soar, not driven by actual value, but by speculative forces and excessive borrowing. Over the past 15 years, the United States has witnessed this scenario, fueled by historically low interest rates that made borrowing exceptionally affordable for both individuals and businesses. In this landscape, let's envision a practical example: a young couple eyeing a $200,000 house. With low interest rates, mortgage approval becomes a breeze. The catch, however, emerges when interest rates start to climb. Consider the couple's mortgage has a variable rate. As rates increase, so do their payments. If their income fails to parallel this surge, financial strains arise, potentially leading to defaults and repossession of the house by the bank. This microcosm of risk, magnified across the nation, paints a grim picture of a housing bubble on the verge of bursting. The repercussions extend beyond individual hardships to the precipice of a broader economic crisis. As the bubble is fueled by a combination of low interest rates, rampant borrowing, and inflated property values.
In a low interest rate environment, the market often experiences a boom in property values. Cheaper loans mean more buyers and developers in the market, driving up prices. Your asset could appreciate significantly, boosting your equity without moving a brick. Now pivot to high interest rates. High rates cool down overheated markets, trimming down inflated prices. For you, this means opportunities to negotiate better deals. It's about finding those gems that yield high returns even when the cost of capital climbs. Consider this: every interest point hike can change your debt service drastically. Smart investors don't just look at the current rate, they forecast and strategize for shifts, ensuring their investments can withstand fluctuations. Remember, the goal is sustainable growth, not just riding the wave of low rates.
The imminent burst poses a substantial threat, with the potential to unleash economic turmoil of unprecedented proportions. Non-recourse debt and its impact.
I'm also looking for non-recourse loans. Once the property is stable, you don't have to personally guarantee the loan anymore. You can get a non-recourse loan where, there's something called bad boy carve-outs where if you lie, cheat, steal, if you're grossly negligent or fraudulent, they'll come after you. But if you don't do anything wrong and the market collapses or a big employer in town goes out of business and you're running the property proficiently, doing the right thing, and all of a sudden the property is not performing and it's got to go back to the bank, their only recourse against that loan is taking the property back.
Delving into the intricacies of real estate financing, the concept of non-recourse debt emerges as a critical factor shaping the current economic landscape. Non-recourse debt, a seemingly advantageous arrangement for borrowers, allows them to surrender the property to the bank without incurring additional liabilities if circumstances turn unfavorable. This practice, prevalent in real estate dealings, presents a seemingly risk-free proposition for those borrowing substantial amounts, especially in significant transactions like purchasing office buildings or malls. Warren Buffett sheds light on the underlying risks associated with non-recourse loans, emphasizing their prevalence in the real estate market. Individuals enticed by low interest rates may borrow substantial sums, anticipating minimal repayment obligations. However, when interest rates surge or the property's value diminishes, borrowers can simply hand the keys back to the bank, triggering a cascading effect. The impact of widespread utilization of non-recourse loans becomes evident as it disrupts the entire market. The influx of surrendered properties floods the market, creating an oversupply and subsequently driving prices down. Analogous to a town where everyone attempts to sell their cars simultaneously, this scenario causes a market imbalance with far-reaching consequences. Buffett underscores the potential for such practices to destabilize the economy, emphasizing that when numerous individuals resort to returning properties, it not only jeopardizes their financial well-being, but poses a systemic threat that can lead to an economic crisis. The ripple effect on small businesses. Warren Buffett's timeless advice:
The reason we haven't used our cash a few years ago, we just didn't find things that were that attractive. But when people talk about cash being king, it's not king if it just sits there and never does anything. There are times when cash buys more than other times, and this is one of the times when it buys a fair amount more, and so we use it.
There's a time to accumulate and a time to spend.
Absolutely. Yeah, you want to be greedy when others are fearful, and you want to be fearful when others are greedy. It's that simple.
Fearful when others are greedy and greedy when others are fearful echoes profoundly when examining the cascading impact of economic shifts on small businesses. As we navigate through Buffett's insights, the focus shifts to the interconnected web between real estate dynamics and small regional banks, unveiling a pattern that historically repeats itself during economic downturns. Regional banks, enticed by the allure of easy money during prosperous times, often extend loans generously to local businesses and homeowners. However, the repercussions of this exuberance become starkly apparent when the real estate market faces challenges. The banks, having heavily invested in a particular area, find themselves in turbulent waters when property values plummet or borrowers struggle to meet loan obligations. Consider a scenario where a small bank in a town has extended loans to numerous businesses on Main Street. If property values decline or businesses face financial adversity, the loans held by the bank may turn sour. This concentration risk becomes a vulnerability, potentially leading to defaults and financial strain on the bank. This domino effect directly impacts small and medium-sized enterprises, SMEs. When local banks grapple with financial woes, obtaining loans becomes a formidable challenge for these businesses. Stock market worries and interest rates. The storm clouds looming over the economy extend to the stock market, casting shadows on some of its biggest players. Notably, renowned companies like Tesla, Alphabet, and Nvidia have experienced substantial declines in their stock values, signaling red flags for investors. These significant drops, such as Tesla's 13.2% fall in just 1 month, underscore the mounting troubles on the horizon. A pivotal player in these unfolding events is the Federal Reserve, orchestrating changes in interest rates since March 2022. With a series of increases, rates have surged from a mere 0.25% to a notable 5.5%. This abrupt shift has created an air of uncertainty, making market participants nervous about what the future holds. As Fannie Mae predicts an economic downturn in the first half of 2024, the stock market braces for the impending challenges. Buffett's analogy comparing interest rates to gravity resonates. Higher rates pull down stock prices, impacting borrowing costs and hindering the growth of companies reliant on substantial loans. Investment strategies in uncertain times. Navigating the turbulent waters of economic uncertainty requires a strategic approach to safeguard one's financial well-being. As Warren Buffett wisely advises, attempting to predict market downturns is akin to predicting the timing of ocean waves, a challenging endeavor. In these unpredictable times, the golden rule of investing comes to the forefront: stick to your financial plan. If unease about the stock market prevails, consider a prudent shift in your portfolio, redirecting a portion into longer-dated bonds. These bonds often serve as a safer harbor during periods of stock market volatility. However, caution is imperative in real estate endeavors. Purchasing property should be driven by sound reasons, not merely the allure of rising prices in a speculative bubble. What rises rapidly can, just as swiftly, come crashing down. For those already invested, vigilance is key. Monitor market trends closely and be prepared to adjust your investment strategy accordingly. Warren Buffett's philosophy shines through view challenging times, not just as threats, but as opportunities for growth. Even in the face of recessions, Buffett remains a buyer of American businesses. Embrace the downturns as chances to enhance your portfolio. In the grand tapestry of investment, recessions are inevitable, but being paralyzed by fear may cause missed opportunities during the inevitable upswings. In conclusion, Warren Buffett's warning serves as a wake-up call for investors and individuals alike. Economic storms may come and go, but a well-thought-out financial plan can help weather the turbulence. Whether it's adjusting your investment portfolio or being cautious in real estate dealings, the key is to stay informed and prepared. As Buffett once said, view challenging times as a chance to grow your portfolio. What are your predictions for 2024? Share your thoughts with us in the comments below. If you enjoyed this video, then don't forget to like, share, and subscribe to our channel for more insightful content. Thanks for tuning in, and until next time, happy investing.